Thank you so much, everybody, for being here. My name is Eric Simonson. I'm the founder and CEO of Abundo, and I'm joined today by Olivia Lima, who is one of our amazing advisors. And Olivia actually suggested this topic tonight, something she's very passionate about and volunteered to do this. And so I'm really excited to hear what she's going to have to say. Olivia, a little bit of background about her really quickly. What makes her uniquely qualified to have this talk tonight is she actually has her PhD in psychology, and there's so much overlap between psychology and market volatility. And then Olivia also has her bachelor's in math. And so she is going to get to a lot of good information tonight. And if you have any questions, go ahead and use the Q&A button on your screen. There might not be a lot of time for Q&A, but if you leave your name, we will make sure we get back to you or your advisor gets back to you if we don't have time tonight. And with that, I'm going to turn over to you, Olivia, to get started.
Thanks so much, Eric. And I should say that although I proposed this webinar, it is not a prediction of any kind. We do not know when the next market crash will come, but we know there is one coming just because the markets are cyclical. So there is always a crash coming. And since it could happen at any time, our job is to be prepared at all times. And I would say it's not an exaggeration, thinking of the data, to say that your success as an investor hinges almost entirely on how you handle market downturns. So that's why we want to make sure our clients are extremely well prepared, and that's our whole purpose today. I would add that when it comes to market downturns, you should not take your cues from the financial media or from social media. They're always going to be in histrionics. Either they're in histrionics because everything is too high or because it's crashing. There's really no in between. What I want you to be able to do is recognize when all of that panicky news starts that, oh yeah, this is just turbulence. This is typical market behavior. Yeah, Olivia said this would happen. Our agenda for today, we're going to talk through 5 main areas. And again, I concur with Eric, get pen and paper. Hope you can jot a few things down. My goal would be for you to jot down maybe one fact where you think, wow, I didn't know that before. I feel a little better now. One thing that you are promising to do, promise to yourself in the next crash that you're going to do differently, and one thing that you can do now to prepare. Because we're going to cover all of those areas today. We're going to talk about how typical markets behave, what a healthy market looks like. We're going to help you understand what your personal risk is, opposed to just what's happening in the market broadly. We'll talk about when the crash happens. First of all, what not to do, why it's so important to stay the course. And second, a few things that you actually can do that are productive when a crash occurs. And then lastly, things that you can do right now to get yourself, again, well situated and well prepared. I'll be showing a number of different graphs today. So here are the disclosures for those to get those out of the way now. Some of the charts I've borrowed from different advisors and firms, and those have watermarks on them. If you don't see a watermark on a chart, it is one of mine. In addition to those charts, you can listen out for 4 different metaphors for the stock market. And so let us begin with that. Section 1, understanding typical market behavior. A healthy market is a wild ride. Markets have phenomenal growth over the long run, over long spans of time, but it is very up and down along the way. This is not an escalator, with music playing slowly in the background. It is, more of a roller coaster. And why do I say the stock market is like a roller coaster? Because it's all fun and games? No. Because it reaches crazy highs and then has gut-wrenching plunges? Yes. Because it goes down a lot faster than it comes up? Also yes. But this is the biggest reason. And I really want you to remember this. You only get hurt if you jump off. And as you can imagine, from a roller coaster, you could in fact get quite badly hurt if you jump off. So this is the reason we, your Abundo advisor, will be working hard, fighting tooth and nail to make sure you stay buckled in, right, and follow the plan when the market is crashing. Now, it's totally fine to decide at any time, wow, this roller coaster, this one is a little much for me. Can I ride the kiddie roller coaster instead? And yes, absolutely, we can adjust your portfolio. But we're not going to do that while it's plunging. We don't jump off to get into a new portfolio. We have to wait till the cycle ends, right? And then for the next ride, we could look at a different one. Now, of course, you might be wondering, why would anybody possibly jump off a roller coaster? Well, people actually do this all the time in the stock market. This is how most people lose money in the market. And astonishingly enough, even though the market is a money minting machine, the majority of individual investors do lose money. Why do they jump off? Three reasons. It's always one of the three. First one, of course, you've got the teenagers who want to pull crazy pranks. In the market, this is the people who think they're so smart and they're going to dodge in and dodge out and they're going to manage to avoid the crash and then they're going to come back in. And that kind of attempt at tactical maneuvering is likely to leave you very badly burned. Our goal instead is to just keep investing through the crash, not try to avoid it. Second reason that people jump off is when their hand is forced. So somebody has to sell stocks at a deep loss because they need that money to live on. This is something we can really prevent upfront by making sure you're in the correct portfolio. Your advisor will talk through what are your withdrawal needs over the next few years. Make sure we have enough in cash and in bonds so that the stocks are only your long-term money and you're not going to be forced to jump on that. And the last reason, honestly, the most common one that people jump off in the market is just panic. Again, hence our goal for today to become really well emotionally and mentally prepared for market crash so that you do not succumb to that. Now, of course, you might be asking yourself, why are we on the roller coaster again? Do I have to ride a roller coaster here? So let's talk about the economy versus the market. The reason we're on the roller coaster investing in the market is that we want to invest in the economy, and the market is our tool to do that. So for our second metaphor, the economy versus the market. So this is Ralph Wagner's wonderful analogy. So the economy is like a man who's walking a dog. The dog is the market. Imagine a very excitable dog on a very long leash, and it's just like jumping all over the place. If you were to watch the two, the man is just walking along mostly steadily. The dog is sometimes racing ahead. It is darting off to the side when there's a squirrel. It is lagging way back, sniffing God knows what on the ground. All right, sometimes the man has to stop and wait for the dog to catch up. Sometimes the dog stops, waits for the man to catch up. At any point in time, they're not in the same place, or moving at the same speed, or even moving in the same direction. But at the end of the day, they're on the same walk. They start in the same place, they end in the same place together. So don't get distracted by the dog's movements. Don't try to predict its frenzied little squirrel jumps. Instead, keep your eyes on the long run. We're investing in the economy. The market will get us there. All right. That's a lot of metaphors. Let's start looking at some actual charts of what does this look like in the market itself. What does it look like to see a volatile market? What does it mean to zoom out and take the longer view? If you Google VTI or any of the funds you hold, this is what it's going to show you, right? It's going to show you the day performance, like how is it doing today? I took this one a few days ago. In this case, red, all red, down 0.5%. Ooh. Thing is, we don't care what the market is doing today. We only care what it's doing on the span of years. So let's zoom out. Oh, here's the market's 1-year performance. It's up 14%. Today's little bubbles, it's just tiny little jagged ups and downs along the line of this very long growth curve. What about 5 years? Even more impressive. This, by the way, was that tariff tantrum there, right? Rebounded, we're way higher than that already, less than a year ago. All time. This one is going back to around 2001. Look at that amazing curve, right? And this, by the way, was the great financial crisis. It was a huge deal at the time, but it almost flattens out in the long run of watching the market growth. And this volatility of the market, to be clear, is a feature, not a bug. This is why you get better long-term returns in stock. If you have the guts to ride out the lows, you get a chance to reap the rewards. It does mean that for your own well-being, you should not look at the market too often, because you're much more likely to be disappointed with seeing it down if you look at it frequently. In fact, if you were to check the market every day, it's almost a coin toss whether you'd see it up or down. It's only a slight edge, slightly more often that it's up, and that's enough to create that amazing long-term growth. So Don't look at the market daily. The longer we go in time spans, looking at a month at a time, a year at a time, 5 years, 10 years, you can see the pattern here. By 10 years, almost all 10-year periods that we've had in the US S&P 500 have been positive. By the time we get to 20, all of them have been. Is it a guarantee that all of them will continue to be? No, but very, very clear pattern here. So don't look too often. And this isn't really like, don't look behind the curtain. This is more like, don't look too often and definitely don't look down. If we're in the middle of one of those plunges, you'll just be suffering unnecessarily at that point. So what does a typical market year look like? One thing to understand is that there's enormous, even at the level of 1 year, an enormous amount of range in performance, and that is totally normal and healthy in the market. So this is showing going all the way back almost 100 years. This blue line is the average return of the markets, but you can see that they're very widely spread. Even though the average here is a 12% return, that's one that includes dividends and is not inflation adjusted, 12% return, but such a wide range. There have been 50% down years and 50% up years, amazingly enough. So two things that are key to understand about this graph. One is, again, the market is up more often than it is down. In fact, almost 3/4 of years are positive in the markets. The second is that, again, enormous volatility. So actually almost 3/4 of the years are double digits up or down. They're not close to 10 or 12 here. They're not here. They're out on these edges here, 10, 20, 30, 40, 50% up or down. That is completely normal. Another thing that's completely normal is to be seeing corrections during the year, right? So the news always gets hysterical about this, like, oh my God, the market is down 5%, right? And clients are calling us like, what should we do? 5% down is nothing. Almost every single year, going back 50 years or more, the market has gone down at least 5% during the year. Again, dog movements, not a big deal. In fact, even 10% down is really, really common, right? The 10% is officially called a correction in the market, and it happens in roughly one out of every 2 years. So really not a big deal to see the market 10% down. For that matter, bear markets, which is when it is 20% down or more, although those are less common to see, they're still relatively frequent. So 1 out of every 8 years has seen during the year the market dip at least 20%. So not a big deal. Another thing you hear a lot about in the news, although it is not actually unusual at all, it's very normal, is concentration in the market. So you're going to hear, oh, the Magnificent Seven, the market is highly concentrated. This is unprecedented. It's a huge problem. No. Concentration is a little high right now, but it is normal for the market to be concentrated. This slide is showing you out of the S&P 500, the 500 largest companies in the US, what percent of the market value is held by the top 50 companies? So the top 10% of the 500 companies, how much value do they hold? And notice it is often quite high. We're in the 60s now. That's not uncommon. We've hit 60s before. It's always somewhere between 40 and 60%. So it's typical for the market value to really be concentrated in the amazing winners. And there's a very long tail of companies who are not doing as well. That is just the structure of the market, and that is going to be the structure of the total market index funds you hold, which are replicating that market. I have seen now several times in the news, oh, the concentration is, over 60%. That happened in the dot-com bubble, and then the market crashed. It's like, well, yes, but that has also happened at other times when there wasn't a crash. The crashes have sometimes happened, the recessions that are marked here have sometimes happened when the concentration was low. So there is not actually a connection where a concentrated market means a recession or a crash. It does not. So that gives you a sense of the broad, how the market performs. But let's take a look at your personal portfolio and how you might expect your portfolio to perform. And of course, a check on how exposed actually are you at this time. I want to start with discussing the spectrum of risk, which is to say, what kinds of things are you invested in the whole universe of things a person could invest in? What does Abundo suggest their clients invest in? Well, we might have you in some cash, treasury bills, some bonds, some stocks. And if your portfolio has a lot of stocks, maybe even 100% stocks, that's going to be described as a very aggressive portfolio. But the thing I want you to keep in mind is even if you're in all stocks, the stocks you own are total market index funds. So we're still actually really low on the spectrum of total risk. What else is out there? What other investments are out there that are much more risky that we would not put you into? There's concentrated funds like sector funds. Individual stocks, way more volatility, can go to zero. Commodities, options, crypto, private equity, margin or leverage. We don't recommend any of those things to our clients. It's funny because I remember talking to my partner once and mentioning something about how I'm a very aggressive investor, because at the time I was 100% stocks. And he looked at me and he laughed. He was like, "You must be joking. You only buy index funds." It's like, okay, fair. I'm aggressive for stocks, but I'm staying over here on the index fund side. Importantly, not only is the likelihood of a loss higher in these higher risk ones that we avoid, but the size of the loss is much higher. So it's almost impossible for an index fund to go to zero. The total market index fund goes to zero. That would only happen if the entire value of the whole economy went to zero. Theoretically possible, very unlikely. Your portfolio would be the least of your worries in that condition. So this isn't going to go all the way to zero. These things can and do frequently go to zero. Margin, where you're borrowing, you can lose more than your original investment. You can end up owing more at the end. So much more moderate side over here. Okay, your portfolio versus the market. Here's another distinction. When you hear that, oh, the market is down X large number, it's probably not the case that your portfolio is actually down by that same amount, because your portfolio is not the same. When they talk about the market, they're often talking about the S&P 500 or maybe the Dow Jones, right? A segment of the market. But we don't have any clients who we've recommended that they invest 100% in the S&P 500. Instead, you're going to be in a more balanced portfolio. So you might be, for example, in a 60-40 portfolio where you have bonds and you followed our recommendation and you also hold international stocks. So the S&P 500 for you in this case is less than a third or around a third of your total portfolio. And so when the news says something like, oh my gosh, the market is so concentrated, Apple is 6% of the S&P 500, which is indeed impressive. Way to go, Apple. It doesn't mean it's 6% of your portfolio. It would be, in this case, only 2. Same if you're hearing that the top 10 are 38%, which is high. That is definitely on the high end of normal, but it is still within a normal range. It's not the highest it's ever been. And for you, you're a lot less concentrated than that. Now, I mentioned the 60-40 portfolio, and that's 60% stock, 40% bonds. How would we determine, how would your advisor have determined for you how much stock versus bonds you should have? This is a fundamental decision in investing. It determines whether you're on the mega roller coaster or the kiddie roller coaster. So it's a very important decision here. Basically, the more stocks that you have, the higher the return potential, the higher the rewards, but also the lower the lows, right? The more the risk. This is showing you portfolios all the way from just plain cash over here to 100% bonds, all the way out to 100% stock. And you'll notice how the funnel widens. So the stock has its good years are better, right? They're really high. Its bad years are really low. And its average performance is the strongest. The more bonds we build into the portfolio, the more we tampen down those big swings, so that the highest years are not as high, the lowest do not go as low. The average performance is lower, but we can still get some decent performance for you even adding in bonds. So it's a totally reasonable dampener, right? Stability mechanism to add to a portfolio. Now, to show you how these different portfolios, this whole stream of portfolios might perform under different market conditions, we're going to look at a few periods in time. And any different period in time we looked at, we would get a different graph, but I've just picked a few that are representative of some of the kinds of patterns we often see. So here is a version where you are investing over a 50-year period. So you're that person who, as a teenager, got a Roth IRA. Don't you wish you had done that? And then you worked till 65, so you had a 50-year investing period. And you were putting in $1,000 a year. In this scenario, which is the last 50 years, you would have done phenomenally well in all of those portfolios. notice that you would have had the highest returns in the mostly stock portfolios, but it was a very bumpy ride along the way. Lower returns in the all bonds, but it was a much smoother ride. One of the things I want to point out with this one is for this particular set of investors, even they had so much good gains leading up here in stocks that even when the big crashes came, right? This is the dot-com, this is the great financial crisis, they were still ahead of bonds and cash, even after the crash. So this can often be the case. And you might say, well, why don't we always put all our money into stocks? Well, because this is not always the pattern of returns that we get. You could instead be looking at a different scenario. This is about the last 25 years. And this is a scenario where those big crashes, the dot-com and the great financial crisis, occurred at the beginning of this person's investing life. They still ended out really well, but it was a hard road to get there. And I want you to notice that about 12 years into this person's investing career, the one who'd been in all stocks would be underwater relative to if they had just held cash or bonds, right? So that you'd have to have nerves of steel to hold on through that. And if you did, you were handsomely rewarded because when the market rebounded, you just shot up with it and had incredible returns. Now, those two graphs are for someone who is actively investing into the market. But what about somebody who is retired? Well, retirees first do need stocks as well because everybody has a long time horizon. It's got to last long enough. This is a 50-year retirement, which most people don't get that long, but we do have a lot of early retirees among our clients, so we need to be able to think that long. In this case, since you're taking money out of the portfolio, in this scenario, this person ran out of money if they had too much in bonds. Inflation, right, took too much of a bite, and they needed to have enough stocks. This dark yellow line, by the way, is a 50-50 balanced portfolio. You hear a lot about it and its cousin, the 60-40, because they often strike a really good balance between the risks of stocks and bonds. So too many bonds in retirement, not good. You need enough stocks to carry you through the long decades and keep up with inflation. Too many stocks is also a problem. If, however, you are the unlucky person, this is that same sequence of 25 years, but somebody's now withdrawing from the portfolio instead of adding into it. And notice that it's going downhill really fast. And for the person who is all in stocks, it runs aground in 10 years, right? So this is not a risk we want to take. You need to make sure you have enough bonds that you'd be able to carry through if you had this sequence of returns risk occur in your retirement. Now, I do want to say, even for the retirees, this is super important. You are always a long-term investor. And this is something I remember hearing from clients in 2022 as the market was slowly falling all year long. You know, I was at Vanguard at the time. I had clients on the phone who were diehard, buy, hold index investors, had been doing it for decades, and they were panicking. And they were telling me, I don't have time to wait for a recovery. I don't have time anymore. I could do that when I was 20, but I'm retiring now. I don't have time. You do have time. Unless you have gotten a terminal diagnosis and you have 6 months to live, you have time. You probably have decades that we need to be planning for. So it's your lifespan that is the time horizon we're thinking about, not when are you retiring. Now, of course, in order to get to the lifespan, to enjoy the long-term benefits, we do have to survive the short term. And it is correct that once you're retired, you need the capacity to take some money out of your portfolio, which is, again, why you don't work with your advisor to say, what are the planned withdrawals? Let's make sure we've got enough cash and bonds ready so that you don't have to run aground, don't get forced to sell stocks, but instead can cover your expenses. All right. So how long might you have to wait, right? How long a period might you need to cover your expenses while you're waiting for the market to recover? This is showing you all of the bear markets that we have had since 1900. So all the bear markets where the market was down at least 20%. This is data coming from data gathered by Kaplan and reported by Morningstar. So for each of these, you can see, what was the event? When did it start? How far did the market go down? We were starting with the biggest crashes and going downward. How long did it last, both to fall and then recover? And this is just a little visual of how long it lasted. The dark bars are showing how many years it was falling, and then the lighter bars are showing the years in which it was recovering. You notice we had two crashes here that were sort of double dips, right? In this case, the dot-com had almost recovered, and then the great financial crisis hit. Similar thing happened after World War I, and then with the flu pandemic that hit, where it had just barely almost recovered, and then it went down again. So on average, kind of the median length that we see here is about 3 years total for a bear market, 1 year down, 2 years back up. But you'll notice that it is possible to have much longer ones. And that's why we want to make sure we have a long enough stretch of fixed income set aside. You can discuss with your advisor how long is a good period for your plans and your risk tolerance. Now, one thing that's really important to understand about these bear markets is this: bears are shorter than bulls. This is the only slide in this whole presentation that has AI images. I asked my team for help. They had a lot of fun with this. And I asked them to illustrate this in order to show you this graph. This is data from Vanguard Global Stock Market. These turquoise bars are bull markets when the market was rising, or at least not falling more than 20%. The orange ones are the bear markets. Notice how much shorter they are. Shorter in two ways. One, in duration, right? The bulls last for more years on average than the bears do. The bears tend to be pretty short. Also shorter in magnitude, right? Because the bears, the most they can fall is 100%, right? Like that's the bottom. the Great Depression, it was down 90% before we adjust for inflation. So they can get way down there. More recently, we've only gotten down about 50%, a little over 50%, which is a lot. But look at the size of the bulls. Look how far they go. There's no limit to how far they can go. So they are up by multiples, 300% up in the case of this one. So bears are shorter than bulls. It's not a law. It's not a rule. Sometimes you get short little bulls and longer bears, but it is a very, very clear pattern in the data. Now, one last thing that I'll mention about the markets, which is to say, sometimes I will show people this data and they'll be like, yeah, that's cool. That's how it used to work. But I'm hearing that today everything is different and we have to throw out the playbook. Not really. Some things are true. It's true that we are reaching all-time highs. That is, however, not remotely a concern. Those are dirt common. If you think about it, anytime the market is not recovering from a crash, it is reaching all-time highs. So on average, there's 20 a year. Obviously, some years don't have any. Some years have a ton of them. Super common. You do not get lower projected, say, 5-year returns if you invest at all-time highs versus not all-time highs. You don't need to be scared of those. They are totally normal. PE ratios are high right now. Price to earning ratios. True, they're on the high end. They're around 30. But nothing extraordinary. Concentration, again, high. We talked about 38% in the top 10 is on the high end for what we see. Not the highest we've ever seen. And certainly there are a lot of political tensions in the world. Although all these things are true, I would argue they're not outside historic bounds, right? They're not unprecedented. And they're not reliable indicators that you should change your investments, right? These are not things that reliably predict recessions or crashes. These are just features of the market as it moves. And you'll be hearing a lot of predictions, but just remember, as the saying goes, economists have predicted 9 of the last 4 recessions. So let us not listen too closely to them. You are for sure going to see all these headlines. Ben Carlson at A Wealth of Common Sense has done a great job collecting all of these. 2013 stock market bubble, that did not happen. Ooh, debt super cycle ending, 2016. No, that didn't happen either. Elon Musk was convinced we were going to have a recession. This was in 2022, lasting till 2024. We did not. To his credit, everybody thought we were going to have a recession, but we did not. This guy in 2023 was predicting massive crash. That didn't happen either. This guy, oh my God, don't listen to this guy, please. This guy has literally since 2011 been predicting an imminent crash. But it's now imminent, he says. You would think that at some point these folks would be embarrassed, right, at their track record. But no, they literally never stop. They're getting what they're looking for, which is the attention, right? Just make sure that you're not mistaking their attention-seeking efforts with financial advice. Ben Carlson has a great quote about this. Charlatans aren't offering advice. They're fear-mongering to draw attention to themselves. So want to ignore all of that. Now, mind you, there are legitimately terrible things that are going to be in the headlines. There are now, for sure. There always have been, and there always will be. The remarkable thing about the world is there's always something terrible happening that has never happened before. Somehow we manage to come up with new terrible things all of the time. But these have always been happening, and the market has continued to grow despite them. So it's a feature of human memory where when we look back, we lose memory for negative events. They kind of fade out in our minds, where the positive events stay stronger. That's what creates nostalgia. So it's easy to look back and forget that all these things happened, forget how uncertain the markets felt, how dangerous it felt to have these various things occurring. We know that it feels uncertain right now, but it has always been uncertain, and it always will be. I should say, occasionally people will ask me, okay, but what if it's different this time? What if this time we have finally hit something that's completely, literally unprecedented? Well, I don't dismiss that possibility. It is real. My family fled Cuba when Castro took over, and we're refugees, lost everything, had to start over. That can happen. You might have to start over. But that situation is A, fortunately very rare, and B, it's not something we can solve in your investment portfolio. So if you're concerned about that, thing to be focusing on is build diverse practical skills, strong social networks, emotional resilience. Those are the things that get you through collapses. Meanwhile, for the 99% of cases, we're going to build your portfolio for the 99%. And this is what we are banking on and hoping for. The amazing growth that the stock market has had over all these many years. This is going back to 1870, right? Despite all of the crashes, all these bear markets along the way. Okay, so that's what you can expect for your portfolio, how it might behave over time. But what about when the crash hits? What can you actually do at the time the crash hits? Most important thing, stay the course. You're going to hear this all the time. Why is that? So in a bear market, when the crash finally happens, that's the time when the market is shaking out all the traders who aren't serious. All right, the day traders, the folks buying meme stocks, the ones in over their heads without a plan, the ones who got greedy and were chasing the latest trend, they all clear out. And who's left standing? Well, according to JP Morgan's great quote, in bear markets, stocks return to their rightful owners. And that's you, the long-term investor. How do you stay the course so you hold on to your stocks in a bear market? Well, on to my next metaphor here. We can think about your portfolio as a ship at sea. We are launching this out to carry you toward your goals. It's a very long voyage. You have decades and many plans ahead of you. So we want to build something, first of all, in your portfolio that is very sturdy and very powerful. This is not like a little pleasure jaunt around the harbor where we might get something, a fast little zippy hydrofoil or something. Like, no. We're crossing the Atlantic. So sturdy and powerful to get you all the way there. The other thing I like about the metaphor of portfolio as ship in a storm at sea is this is a reminder to us that although we can talk about what kind of ship you want to build, and we can definitely have good conversations about the trade-offs between engine power and stability, we can set up the ship the way that's best for you. When the storm actually hits, that is the time to batten down the hatches. That is not the time to rebuild the ship in the middle of the ocean. So when the storm hits, really crucial to we made a plan, now we're executing the plan, and we're going to hold on tight. And I do want to emphasize here for you as well, when this happens, when the market crashes and you reach out to your advisor and you say, oh my gosh, what should we do? What should I do? And your advisor says, hold tight, stay the course. This is not laziness on your advisor's part. It's not that they don't want to come up with advice to give you. It is the opposite. We are paying close attention to this. We are investors too. We want you to succeed. We are looking out for your best interests. Your best interests require staying the course. Require it. So this isn't optional. This is not like, oh, you don't have to do anything, right? No, this is for the love of God, do not do anything. Hold tight. Interestingly, some research that Vanguard has done on what they call advisor alpha, the difference, the actual quantitative money difference in people who have financial advisors and don't, and how their portfolios grow. The single largest factor that contributes to the edge of having an advisor, the single largest factor by far, behavioral coaching during a crash. That's more than double the effect of the runner up there, which is like tax optimization. So this is in a really critical role that we'll be playing for you in a crash, is to help you stay the course. And we've had good markets for a long time, so you might be telling me, yeah, okay, fine, stay the course, I got it, I can do that. But I want you to be aware that investing is a very emotional process. You are going to experience this cycle, right? You are going to have moments where you're experiencing desperation, panic, despondency, depression. This is going to happen. It might not have happened to you in the last market crash. It might not happen in the next. But eventually, at some point, especially when you have more money at stake, maybe you're close to retirement or in retirement, you should expect that you're going to feel the feels. You are not immune. The thing you can do at that moment is ground yourself and remember, okay, I'm seeing the dollar value of my portfolio go down. But what I own in my investment accounts is not dollars, it's companies. Okay? So an investment account is not like a bank account. In a bank account, you just own dollars. If the dollar number balance in your bank account goes down, you have lost the dollars. They're gone, they're not coming back. But this is different in an investment account. So here's a little Roth IRA, it has $42,000. Great. Are there dollars in there? No, there are no dollars in the Roth IRA. What's in there? It owns two funds, an international stock market fund and a US stock market fund in our recommended balance. This is what it owns, this quantity of shares, 261 shares of the international, 183 shares of the US. And each share of that mutual fund, because each of those owns thousands of companies, means you own a tiny portion of thousands of companies. The dollar value is going to change literally every day. Even if I did no trading in this account, the dollar value is going to be going up and down. It's going to change quite dramatically over time. This is not going to drop, though. This is what I actually own. So when you are watching dollar values drop in a market, what you want to remind yourself of is, okay, the value of your assets has dropped, but you still own the assets. The number of assets you own has not changed. You still own companies, good companies, full of millions of people who are working really hard. So at the end, what you're going to be facing and need to be ready for here is a huge emotional test. All right. I don't know if you've seen Dune before, but this is the Gamja bar. If you haven't seen this scene, this is where the son of the Duke is told he has to put his hand inside this pain box. Puts his hand in, and then the Bene Gesserit sister is holding a little Gamja bar at his neck, and if he takes his hand out of the box, she'll use it to kill him. So he must keep his hand in the box. But it's a pain box. And as he's holding it in, he's experiencing excruciating, intensifying pain. And I use the David Lynch version of the movie Picture because I love how they depict it. You get these close-up scenes of the hand like burning and melting. It's very gory, right? He withstands it. He holds tight. He passes the test. She tells him, enough. She tells him, you can take your hand out of the box, which initially he doesn't want to do because doesn't even want to see what has happened to it. But she insists, take your hand out of the box, and he pulls it out. Totally whole, unharmed, fine. This is going to be you in a stock market crash. You're going to be feeling the pain. The pain is very real, watching the dollar numbers go down. But nothing has happened yet to what you own. Your hand is not yet harmed. I have people tell me in crashes, stop the bleeding. We've got to sell the stocks. You have to stop the bleeding. I can't see it go down any further. But there's no bleeding yet. As long as you're still holding strong, as long as you're still holding your assets, you own just as much as you've ever owned. Now, if you cut off your hand at that point, then we're going to have bleeding. If you sell out, then we've got significant bleeding and it is not coming back. That's why you must hold tight. This was his little mantra that he repeated himself. Fear is the mind killer. You can repeat this to yourself and add, I own companies. This is a little demonstration to show you what happens if you don't follow that advice and you sell out at the bottom. And this is a relatively small crash in the world of crashes. This is the COVID crash. And what you're seeing here is the orange line is somebody who couldn't take it anymore, sold out at the very bottom, went to cash, stayed in cash. Notice that the people who were fully invested, this dark green line, they rebounded and they've grown phenomenally since then. This person totally left behind. This is somebody who went to cash for a month and then got back in. If you ever find yourself in the horrible position of actually selling out to cash, you must get back in as quickly as possible. You still have a permanent loss, but it will be smaller. The longer you stay out, right, the deeper the depth of what you're missing. So remember, in the case of a market crash, if you wait for the dust to settle, the market will leave you in the dust. Stay in. In fact, even missing a few days can cost you. You might have seen a graph like this before. This is looking at 30 years of growth in the stock market. And if you put $10,000 in, you ended up with over $220,000, which is incredible. But what if out of those 30 years, you missed the very best days in the market, just a few of them? If you missed the 10 best days in 30 years, you had half, less than half the value at the end. And the more days you missed, the more you lost. By the way, most of these best days happened during bear markets. So you cannot afford to be jumping in and out. You have got to stay the course, be laser focused, keep going through it. The good news is, even if you experience a market crash, you can be a very successful investor. In fact, you should expect that your journey to being a successful investor is going to include a lot of crashes. Successful investing is not linear. You've probably seen this on your right capital. I dislike that it kind of implies a smoothness to the growth, which is not there. What you're actually going to have is a very jagged line somewhere in this range. I will never forget seeing this on a blog years ago. This is my now colleague, Chris Mamula, his first financial blog where he was charting his family's progress toward financial independence. And he was tracking portfolio value as a reflection of how many times of their expenses. And this was a goal level they had set. And, I started reading this toward the end when things were going really well and got to see them make it through. But I remember looking at this graph and thinking to myself, wow, if I had started looking at this earlier, like maybe here, and didn't know how it ended, I might have been worried, like, wow, I'm not sure this plan is working so well. You're years in and you're actually falling behind. Like, is this working? And yet, that's what an incredibly successful path looks like. So even if you had to go through the worst of crashes, even if you had to go through the Great Depression or something like that, you can still be successful. All right. Now we're getting down to things that you can actually do. You've learned what not to do. Do not sell to cash. Do not change your portfolio. But what can you do? Some of it is mind tricks and some of it is portfolio action. So on the mind level, when you hear a scary number, the market is down by some scary percentage, always check that against okay, but how far back have you actually gone? Because if the market grew a lot and then it started to fall, you're not that far back. This is where we were as of earlier this week. And from that moment, if the market were to drop 10%, that would have only put us back to August. If it dropped 20%, that would have been last April, the whole little tariff drop. 30%, that would have been, a couple of years ago, 2024. 40%, that would have been 2023. So even a 40% drop actually doesn't put you very far back. And in fact, I distinctly remember in 2023, everybody telling me that the market was way overvalued, way too high. All right, second thing that you can do, make sure that you tune out the news, right? Those crazy headlines, we are not paying any attention to those. They are not useful. Focus in on wisdom. If you are somebody who meditates, great. You can literally focus in on wisdom and the good things in life. There is, by the way, I have to mention this, a fabulous meditation on YouTube. If you look up J.L. Collins meditation for when the stock market is dropping, he's a fantastic writer, has an amazing radio announcer's voice and a great sense of humor. And he literally goes through the breathe in and breathe out and what to remember about the market over the scene of these events. It is both hilarious and incredibly helpful. So you owe it to yourself to watch it now so that this will come to mind to you later in a crash. That's it. If you're not a meditator, if you're like, no, Olivia, I can turn off the news, but I need to be reading something, doing something, fine. There are many fantastic classic books about the markets, investing, financial independence. Focus in on those. You will learn so much more. Third thing you can do in the midst of a crash, keep buying. To use Nick Majuli's term in the title of his recent book, just keep buying. This is so, so important. You know, the stock market is the only market where things go on sale and everybody runs screaming out of the store. You don't want to do that. You want to stay, not only hold the portfolio you have, but continue to buy. We would never advocating waiting to buy until there's a crash, but if you are in buy mode, if you are an investor who's contributing into your accounts, keep contributing in, keep buying. Now, mind you, it's not going to feel good. It's not going to feel like a sale. It's going to feel like you're lighting money on fire. I don't know if you've seen the South Park episode, take money in the bank. Oh, thank you. We put into this fund and it's gone. It's going to feel like that because you're going to put money in and then the next day you log in and your balance is lower. It's like, how am I putting money in and it's lower? It's just like poof. But it's not poof because you own companies, not dollars. So what you're buying is shares at a discount. You're buying good companies on sale and you're building up a stockpile of those shares that becomes rocket fuel. That as soon as the market turns and starts to recover, your recovery is going to be much faster than someone who didn't buy in. And by the time the market gets back up to even, you're going to be way ahead. In fact, these market sales are a huge opportunity to get ahead on your goals, to make a huge leap forward toward the goals that you are investing toward. Number 4, that you can do during a falling market, control what you can control, and your expenses is a very big part of that. Minimize taxes. This is our same drumbeat as always, right? Minimize taxes, minimize fees. Reduce your debt, right? You don't want to be overextended if the economy is tightening. Know your spending, right? Track your spending and budget so that you understand exactly what you're spending and keep a healthy buffer, right? To have a high savings rate is magically powerful in 2 ways. A, because it lets you accumulate a good emergency fund, and B, because it means you have a lot of room to absorb income loss without having to make any changes even to your lifestyle. So aim to build the highest savings rate that you can, that is, again, consistent with your goals and where you're heading. 5th thing you can do is lend a hand. Crashing and we're in a recession, and you are better off than a lot of the people in your community and help. Thanks to Chris Mamula for an excellent blog post on COVID reminding us all of this. All right. Finally, portfolio action. I know you really want to know, what can I do with my portfolio in a bear market? Basically, what you're going to do is follow and implement the plan that you had in place. So rebalance. Your portfolio may have drifted enough that you can do a mid-year rebalance, which will give you the advantage of buying on sale. If you're actually far down enough to have losses, you may be able to engage in tax loss harvesting. If you had not yet sold your concentrated positions, this might be an opportunity to sell low and rebuy low with a lower tax bill. And it might be a time to do Roth conversions if that's something that fits in the context of your plan. Last thing that you can do in a bear market, and we hope you will do this, is reach out to your Abundo advisor. So we are here for you. This is a big part of our job to support you in these times. If you have tried really hard to stay the course and to not panic and remain focused, but you're feeling really anxious, it is okay. Reach out to us. We are happy to meet with you, talk to you, reassure you, and help you hold on tight. All right. Now we're getting toward the end, and I'm into my last section now, which is things that you can do to prepare. So those are all things you can do during a bear market, but what can you do now so that you are prepared in advance of the next crash that comes? Well, for starters, all the prior advice still applies. So all those things, it's almost like we're giving you timeless wisdom for success as an investor, right? All those things still apply. Some little adjustments that we would make if we're not in a bear market. When it comes to your portfolio, you don't have to just stay the course. If we're not in a bear market yet, it's a good time to evaluate, are you in the right portfolio? You want to make sure you're in the right portfolio for the long haul. Notice I'm not saying the right portfolio to position yourself for a crash. Like, no, 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 no. The one that you can hold all the way through a crash and beyond. Now, this might be you. You might be sitting there at 100% stocks and you might be realizing like, this is maybe a little more than I want to deal with. That's no problem. We can make that adjustment. But don't make an adjustment prematurely based on where you think the market is going. Make an adjustment based on what you can hold sustainably for decades. So talk through with your advisor. Is your portfolio fully diversified, or is there more work to be done? What is your actual risk tolerance? How much do you need for cash reserves? And what is your timeline to retirement? And do you want, for example, to be able to retire sooner? Do we want to take some money off the table? Which leads me to another, a little connected to this reminder, which is to check. We have a lot of clients who've been enormously successful in the markets over many years of saving and investing. And you do want to check and see, have you won the game? This is the last metaphor for the market, and I hesitate to compare it to a casino because in a casino, you're going to lose in the long run. In the market, you're going to win in the long run. But in both cases, you are putting some money at risk. So you want to evaluate for yourself. If you've already reached your goals, maybe you don't need as much to be in stocks right now as you did when you were looking for growth. Basically, the question to ask yourself is, okay, how would your life change if your portfolio, for example, doubled? You might have already reached a point in your growth where it's like, you've already got all your goals funded, so doubling would not actually meaningfully improve your life. But what about if it got cut in half? Maybe that actually would make a big difference. And if that's the case, then this is a good time to take some chips off the table. One last set of things that you can do in preparation now, mental preparation, Jedi mind tricks. So now we've got the more recent Dune with Chalamet, and I apologize for mixing the fandoms of Dune and Jedi, but bear with me there. Here are some things to focus on. As I've said before, I really need you to be humble. You are not immune. It's easy to get cocky, to feel like I handled the last recession well, like I'm going to be fine in this one. But again, my experience talking with those Vanguard advisors taught me to be humble of, you're not going to always be immune to this. Reading firsthand accounts for me has been enormously helpful. You could Google, there's a great Bubbleheads thread from back from 2008, 2009. Again, people who'd been investing for decades in this index, really committed to indexing, buy and hold, and they were about to pull the plug. They just couldn't take it any longer. So to read that experience helps you, okay, when you reach those moments and are going through, it's like, it's okay, I can feel like this and still hold on and still be successful. Got that meditation I gave you. I suggest you build up a little stockpile. There's so many great quotes about investing, your favorite quotes, your favorite facts, things you can look at in the future to remind yourself. And there's a few little exercises you can use now. I think of this as a sort of stoic exercise of anytime I look at my own portfolio, I look at it and say, balance is X. Okay, so if the market were to drop 50%, I basically have half of X. So if you're looking, you see, $1 million, and tell yourself, okay, so I have $500,000. $400,000, okay, so I've got $200,000. $10 million, okay, so I've got $5 million, really. In a similar vein, don't get too attached to the dollar amounts you're seeing. This is not like a bank account where you bank them and then they're solid, right? This is going to be fluctuating. You're going to see them up, you're going to see them down, you're going to see them up again. So anytime you're looking at an all-time high, you could think of it as, this is a future preview, like, wow, this is amazingly high. It's probably going to go down from here, but then eventually I'll get back up to this. So I'm seeing a preview of future gains. All right, might have a few minutes for questions. I will make my concluding statements here. You all, we are ending where we began. You all have seen this slide in your prospect meeting when you first became an Abundo client. And although you may not have focused on it at the time, I want you to notice this deep cloud layer. You don't get to see the whole journey in advance before you start, but you can still have a beautiful and thrilling journey to embark on. We want you to feel as confident as a human being can possibly be in this uncertain world. We want you to be able to serve as a resource even to your friends and family when they're getting panicky and don't know how markets work. And if they want more support, you can refer them to us. To be clear, we cannot predict the future. No one can. No one knows what will turn out to be the best investments to hold for the next 30 years. So I can't put you in that portfolio, and no one can. But I can put you in a portfolio that has the best odds, the most resoundingly strong evidence over more than 100 years. World wars, depressions, changing world orders, through the space race, the invention of computers and the internet. What will the future be? It will be quite a ride, and we're here to navigate it with you.
Thank you so much, Olivia. Oh, so good. Fantastic information. And we do have two questions.
Okay.
First one I know you addressed, so I will answer it really quickly, and that is just what is the definition of a crash versus a bear market? Technically, there's really no such thing as like a crash. It's a correction is what happens when you get to 10% down. What's funny is, if you're down 9%, that feels really, really scary, but there's not even a word for that.
Yeah.
And then a bear market is down 20% or more. And then the second question, Olivia, was regarding point five. If I'm following the portfolio advice, if the market dropped 50%, presumably my portfolio would drop less. Correct.
Correct. Correct. Yeah. Yes. Because again, if we say the market dropped 50%, that was probably like the US market or the S&P 500. And that's just a portion. So we would not expect you to experience as deep a plunge. Of course, it's going to depend on what all your other asset classes are doing. But bonds, for example, don't tend to drop as much as stocks.
Yeah.
Setting
Perfect.
aside 2022, which was a wild year, and hopefully we'll never see that again.
Yeah, that was a weird little bear market.
Mhm.
Um, Perfect. Okay, we have probably time for one more question if somebody wants to quick get something in there. Um, Otherwise, yeah, Olivia, thank you again for that. It was full of timeless wisdom, really. I I've heard so many of that, that those concepts before, but I think I still learned something from that, which is great, and hopefully everybody in the audience got a lot out of it as well.
Yeah, well, I hope so. And we all need frequent reminders. And this is a good time to mention, that we've, Eric, that, you and I have discussed, we'd like to have not just this one webinar on preparation, but really a series over the years. I'd love to be able to revisit this topic. Today was a like lightning speed. Wanted to get through all the key points, but I could have talked for 1 hour on each of those sections because there's so much to dig into. So it'll be fun to revisit it over the years. And again, the more exposure you have to these ideas, the more familiar they become to you. So that again, when the crash happens, it doesn't seem like something horrifying and unexpected. It just seems like, oh yeah, this is what we've been preparing for.
Exactly. I heard some Midwest in that. Oh yeah,
Oh yeah,
that's what we've been preparing
you
for.
betcha.
Yep. Perfect. Okay, well, thank you everybody who's here. And again, thank you, Olivia. We will see everyone next month for our next webinar.
Yes, fantastic.
Okay.
Thank you.
All right. Bye.